18.
Good morning. Welcome to Trading Hour. It's a brand new week. I'm Reema Tendulkar. With me are Surbhi Upadhyay and Pavitra Parekh. And what an eventful morning, right? First, the markets opened down, went down to levels of 17,450. Then that intraday pulled back to levels of 17,700. And after that, there has been a grind down in the market. And now we're at 17,550 in the red for the benchmark indices. We've lost about 50 points in the Nifty, the Sensex down 140 points. In percentage terms, we are lower by about a quarter or a third of a percentage point. The Nifty Bank is under severe pressure, so that's underperforming. The Nifty Bank is down close to about 1%. Just a couple of points about the markets and where we are currently. Well, we are at very important support levels. So the 200-day exponential moving average is above 17,593. Last Friday's intraday low is about 17,493. Go below that, you've got the 200-day moving average. So this entire zone where the markets are currently trading at is an important support zone for our market. So after losing 500 points on Wednesday and Friday, can we attempt a bit of a pullback? As I said, this morning we've seen a lot of levels from 17,450 all the way to 17,700. So price levels have been all over, but it's only been about 1.5 hours since the markets have opened up. Now, talking about the Adani Group. The Adani Group stocks, which are in the FPO, so that's Adani Ports, Enterprises and Bajaj Cement, these are the stocks which are currently holding up in the green. That said, Adani Ports, if you pull up the intraday chart, you would now see that it's seen a significant sell-off from the day's high. But at one point of time, the Adani Ports stock was higher by close to about 10%. But the other Adani Group stocks, which are not in the FPO, that's Adani Total Gas, Transmission, Green, Power, Wilmar, these do not trade in the FPO. And there you are seeing lower circuits of 20% for Total Gas, Transmission down 20%. Remember, these are the non-FPO Adani Group stocks. Banks are under pressure. In fact, the banks have been under pressure for the last, couple of trading sessions now. ICICI Bank, 1.5% lower on that. ICICI Bank is down 1.5%. Since the beginning of the year, ICICI Bank is down close to about 20%. So even before this whole Adani issue rose, the ICICI group of stocks were under pressure. State Bank of India was another stock which has been weak since the beginning of the year as it continues to see profit taking. But as you would see, look at the way ICICI Bank has struggled since the beginning of the year. So this the weakness in ICICI Bank actually began a lot before even this whole Adani issue. Bajaj Finance is holding up pretty well in the green. That said, the stock is still about 8 to 9% below the Q3 business update. Remember, the Q3 business update, which came in early January, was a big miss, and the stock fell from levels of about 6,500. So although Bajaj Finance has recovered to levels of 6,000, it's still about 8 to 9% lower than what it was at the beginning of the year. A couple of important earnings as well. We'll be tracking L&T, Tech Mahindra, BPCL, Exide, Gale, and many, many others as well. Hi, someone told me 600 companies report their numbers this week. So add that to that list of how big and important this week is.
The budget, everything that's happening with the Adani Group, earnings.
FOMC, auto sales, 600 companies, someone told me.
Running out of breath already. But, the problem, girls, is that this market is beginning to remind me of Friday all over again. I mean, look at what's happening on the Bank Nifty. It's down 1% again. And pull up the intraday. Reema mentioned Adani Ports. The intraday is telling you a story. For what it's worth, there's still price damage that's continuing. And the Nifty, by the way, the Friday low was closer to the 17,500 zone. And we are barely, 35 points off that right now. So this is not inspiring confidence. On the banks, I just want to make one point. All the bank losers will come up for you. The Bank Nifty is down, again, 1% right now. One of the most important takeaways, and we'll talk about that as we go forward on the show, from the Adani Group is that 23% of their total debt, which is $30 billion, is coming from Indian lenders. And we've had statements from some of the Indian banks, including SBI. Ritu Singh spoke to SBI officials on Friday, that a lot of this is anyway backed by income-generating assets like airports, etc. But none of that seems to be sort of helping sentiment. For what it's worth, people are choosing to go slam dunk on banks yet again. Pavitra, that's something that stands out for me. And I know you're looking at the individual entities as well, but it's largely looking far more red than green like we were hoping at the open.
Oh, absolutely. And, at one point, right after the open, we got that huge recovery. Nifty Bank was up, 600 points from the low. So it looked like things are picking up. You had all of the banks move to the day's high. And now, once again, like we've been telling you, it's at the low point of the day. So the index in itself is down almost 400 points. Initially, we, saw that rally being led by the PSU banks, but that's completely been given up. What's holding up today, in addition to, some of the better earnings, is once again a few of the IT names. So that is one of the few sectoral indices which is holding in the grain, in addition to the pharma pack. So a few of the larger names will come up for you from the IT index. So, take a look at, say, an Infosys, at CL Tech, Wipro. These are still holding in what has, been a very weak market. Of course, we do have NASDAQ, which has also been doing very well. By the way, for all of last week, the NASDAQ was up around 5%. So you are seeing that positive momentum in IT stocks. Some of the smaller mid-cap IT companies also, doing well. So whether it's an Emphasis, Birlasoft, these are all holding up better. But, like we pointed out, on the downside, it is banks and also some of the consumption names. But let's kickstart the show now, and we will start with the big story of the day. There's no surprises for guessing. It is Adani. Earlier today, we spoke with the group CFO of Adani Enterprises on a whole host of issues like the FPO, of course, the Hindenburg issue, and their debt picture as well right now. So Nimesh is here with the key takeaways from that interview. Nimesh?
Hi, Pavitra. So we had an extensive, interview with the group CFO of Adani, and a few things stand out for me from that entire 40-minute interview. The first one is on the Adani Enterprise FPO. That's going to be a big talking point because the FPO technically closes tomorrow, which is 31st of January, and they've very clearly mentioned that they're going ahead with the FPO. Not only that, they're also going to continue with the price band, which is between 3112 to 3276. Remember, the anchors came in at 3276. Now, we put out the subscription details. It's hardly been subscribed as things stand as we speak, but the expectation is that this will come. That's the confidence that the CFO has spoken about, that they're very confident that the issue will go through. There will be enough demand in the FPO as well, and they're going ahead with the initial schedule of the issue closing tomorrow, and they've not changed the price band as well. So that's on the Adani Enterprise FPO, which closes tomorrow. That's the first one. The second one was on the group debt and the exposure of the Adani Group in the Indian banking sector. At a group level, the CFO mentioned that they have a gross debt of close to $30 billion, of which $4 billion is cash and cash equivalent. Closer to $4 billion is what he mentioned. And within that, for the Indian banking sector, the overall exposure is close to 23%. In terms of actual numbers, it works out to around $9 billion if you include the working capital lines as well. So all put together, the net debt of the Indian banking sector for the group is $9 billion, which is not very large if you compare the balance sheet size of the PSU banks as well as the private banks. So that was a clarification as far as the debt is concerned of the Adani Group. And the last one was a clarity on Ambuja Cements. Well, there's a lot of fear that because of the shares getting incumbent for Ambuja Cement, there was a fear that most of the foreign lenders will sell the stock given the slam down which happened in the last 2 days. To that, the CFO has very clearly clarified that these are not technically pledged shares with the foreign lenders. It's because of the Indian regulatory system. It has been classified as incumbent, and hence there is no fear of any foreign lender or any institution selling the shares of Ambuja Cement. So 3 big clarifications. 1, the FPO is on schedule with no changes in the price band. 2, the gross debt is $30 billion backed by cash assets, and the India exposure is very less. And 3, there is no risk of any pledged shares getting sold in Ambuja Cement.
Okay, thank you very much, Nimesh, for so concisely, putting that in front of all of us. In fact, let's hear out what the group CFO, Mr. Singh of Adani Enterprises, had to say about the FPO, SEBI probe, and the Hindenburg research.
We are confident that on the institutional side, that the entire issue is from based on our discussion, roadshow meetings, etc., will be fully subscribed. And that's why we clarified the rumors were going on. So we clarified on Saturday night that that the FPO will proceed on current pricing and on the current timelines. So we are supremely confident that from an institutional perspective, we are there. But there will be some pullback in the retail given such pricing differential and the volatility. FPO will go ahead on the same conditions that we launched. Gross aggregate debt position in the group is just about 30 billion, of which $4 billion we hold in cash, approximately. Just under $4 billion we hold in cash. Because the way the domestic bank is, there was some sanction limit. So if I just go that on a sanction basis, it will be about 9 billion. The first thing is that 0% of Ambuja shares are pledged. What happens is that under SEBI's regulation. SEBI just has a heavier regulation, which is a good regulation, which is simply that please report encumbrance. So and if we say that we will hold 63% under SEBI strict reading of it is considered encumbrance.
The response that came in from the Adani Group, again, just a caveat that this interview was recorded last evening before Hindenburg's latest response, which came in actually this morning. And I just want to bring you up to speed with what Hindenburg is now saying. So this is the latest in the story so far. First of all, Hindenburg has completely denied one sort of claim that Adani made in its response, saying that it's a flagrant breach of applicable securities and foreign exchange laws. So this is something that Hindenburg Research is absolutely denying, that they have not committed any such breach of securities laws. That's point number one. Second, they go on to say that out of their 88 questions, only 62 Adani has failed to specifically address. The remaining questions which Adani did answer, the group largely confirmed or attempted to sidestep our findings. Now, let me come to the heart of the matter. One of the major allegations that Hindenburg has pointed out in its report earlier, and they repeat that in their morning response, is their allegation of related party transactions between Mr. Vinod Adani and the Adani Group. Now, this is something that the Adani Group has refuted in its response. Let me just quote. Our report alleged that Adani Group has engaged in billions of dollars in suspicious dealings with its chairman's brother, Vinod Adani. Adani brazenly argued that Vinod Adani is not a related party to the Adani Group. However, Hindenburg goes on to say, we believe investors should regard Vinod Adani as a related party. So this is one major bone of contention between the two parties. A quick last point. There is some reference to a Chinese national as well. Hindenburg goes on to say that Adani Group has not even attempted to clarify its relationship with a Chinese national, Chang Chung-ling. Now, this Chinese individual allegedly has some linkages or some role in the Augusta Westland scam. Again, these are, I'm simply quoting from the Hindenburg response that came in this morning. These are all allegations. And the final conclusion that Hindenburg has drawn is Adani's response largely confirmed our findings and ignored our key questions. So it's a war of words, and it continues from both sides, at least as of now. I just want to put on the table the number that's relevant from an FPO perspective. Yash sent us the latest details. These are as of, I think, just after 9:30 or 10. The total subscription was 0.01 times. NII was 0.01. Retail was 0.02. Employees was 0.07. So the numbers on the FPO haven't moved too much from what we saw on Friday. Story continues to unfold.
This is as of 10:50 a.m., as you can see on the screen.
Yes.
So that's just 1% which has been subscribed so far.
Oh, absolutely. And this is important for us to track. We will, of course, keep bringing you updates on, how the FPO subscription is looking. But for now, let's also bring in Vivek. He is here with an analysis on what the MSCI impact, of this could really look like. Vivek?
Well, that's right. So what we are analyzing it from the angle of how passive indices will actually now treat the Adani stocks that are part of their indices. So the most important passive index to keep an eye out for would be the MSCI. So what MSCI has done over the weekend is that they've said that they've now put out a consultation paper, and in further course of time they will decide on how they treat the Adani stocks which are part of the MSCI Global Standard Index. What is important to keep in mind is the fact that all of the Adani Group stocks, barring Adani Wilmar, the recent listing, are part of the MSCI Global Standard Index. So Nuvama Research has done a scenario analysis on what could be the possible impact based on various actions that the MSCI index provider could take. So first, what they're saying, 8 Adani stocks which are part of the MSCI Global Standard Index, the weightage is 5.75%, and at the close of Friday's trading session, the cumulative value of all of these stocks is close to $3.5 billion US. So the first scenario that Nuvama highlights is the fact that if price volatility ceases, no action will be taken in terms of deletion. Scenario 2 is that if the volatility continues, the index provider can exclude these stocks and they will have to provide a prior interest intimation or a prior notification. The third scenario, something that we've seen play out in terms of earlier Piramal Pharma, is that the index provider says that they intend to exclude the stocks, but a few of these names could actually be at the lower circuit limits, which is why it will be impossible for people who are tracking this index to go ahead and exclude these stocks. So again, this could play out a little later. Lastly, the fourth scenario is the fact that the index provider can reduce the weightage by, let's say, up to 50%. The cumulative outflow in that case could be $1.5 million.
Okay, thank you very much for that. The key question now is, will the Adani Enterprises 20,000 crore FPO goes through? It closes for subscription tomorrow. Total size 20,000 crore. They've raised 6,000 crore from anchor investors. The balance is 14,000 crore. And for the FPO to be successful, at least 90% subscription needs to come through. Remember, the stock price currently at 2,850 is trading below the band, the FPO band of 3112 to 3276. Even if you take into account the 64 rupee discount, which will be given to retail investors, the FPO price will come down to about 3,050, and the stock is now trading below it. The company is very confident that the FPO will go through. They don't need any change in timelines or the price. Let's find out what the market men are saying about the Adani Group stocks now. Devin Choksi of KR Choksi is now with us. Devin, morning. Your thoughts on the Adani Enterprises FPO? Will it go through? What's the interest now from the retail and HNI clients that you speak to?
Yeah, good morning. Well, I think more importantly, the institution investors matters in this particular FPO, because I think the size of FPO possibly was decided based on, I think, the interest of institutional investor to buy into the infrastructure assets offered by Adani Enterprise. In my viewpoint, I think that proposition has not changed. Though the market price remaining lower, I think the questions definitely would be on pricing, but otherwise participating into the issue, I think that proposition has not changed, as I understand. As far as the retail is concerned, retail definitely would look at, I think, the opportunity in the secondary market where the stock is available at a lower price. So certainly, I think they will not pay the premium. As institutional investor, if they are getting allotted, probably they would not mind, I think, paying that particular premium because they are getting the firm allotment. Let's wait and see how exactly it pans out for tomorrow. But as of now, I think the investment interest, I think, has not went out. I think investment interest remains solid. Pricing part is something which I think one can figure out by tomorrow, I believe.
Sure. Adani Ports down 27% in this month, and a lot of the price damage obviously has happened in the last few days. Devin, good morning. Now, this widely expected short squeeze, a lot of people in the chatter over the weekend was that expect a short squeeze come Monday. That has not transpired. Your thoughts?
Yeah, Sylvie, good morning. I think another factor which possibly I think has started playing role since morning today is MSCI exclusions of the stocks, and I think that could be one of the reasons for which I think many of the names I think are now not probably gaining the ground. I think it's only a fear. Maybe the traders, operators, whoever they are, I think they may probably want to book their whatever position that they've been carrying on, and as a result of which I think in absence of buying, these stocks are seeing the downside circuit and the selling. I don't think that the fundamentals have changed in any of the company's businesses. They remain as strong as they were before. On the contrary, I believe that with the corrected price, or I think that the discounted price completely, I would think that many of the companies are remaining attractive proposition for someone who is basically looking at long-term investment into the businesses of these companies.
Okay, hi Devin, morning. So you're saying with this kind of, price correction that we have seen in a lot of the Adani Group names, you think this would be a good time to, start buying into them?
Yeah, I think the fundamentals have, again, I'm repeating, and fundamentals have remained extremely strong, be it a port business, be it transmission business, be it greens. I think whichever business you look at, I think the fundamentals have not changed. They remain extremely strong and convincing. My viewpoint is very clear. On one side, if the infrastructure assets have been built, and if they've started generating cash, that means I think the investor who is looking at 20, 30 years, typically the likes of insurance companies and pension companies, endowment funds, sovereign fund, infrastructure funds, they are the ones I think who would like to see this kind of visibility of long tenure. And if these assets have started generating cash, I think one can be very, very safe in discounting the valuations for the future. But that is where I believe that I think the attraction point remains. And I think for long-term investors, I repeat, institutional long-term investors, I think this becomes a convincing proposition to buy at lower levels.
Okay, got that, Deven. Thank you very much for sharing your thoughts with us on this important issue, and we'll keep tracking it as things unfold. Thanks for joining in today. Need to take a break on that note, and as we do that, here's some exciting news. The most coveted leadership awards are back. CNBC-TV18 honors the visionaries behind outstanding businesses. Catch the most influential, credible, powerful IBLA jury on the 8th of February, right here on CNBC-TV18. Welcome back. Equities are still sort of slightly in the red, 40 points down on the Nifty. Let's move away and talk about commodities and find out what's going on. Manisha Gupta is joining in as always. Manisha, good morning. So what do you have your eye on today?
Well, I'm looking at the energy prices and some decline, and that should be supportive for the equity markets. But let's find out on what really is happening here. So we have seen sharp decline in the previous week on Friday, and that's how we've started Monday morning as well. 0.5% of decline coming in for WTI and Brent, and markets are clearly looking at the fact that Russia's Baltic ports loading has jumped up by 50% in the month of January as compared to December. So that whole concern about what the sanctions really could do to Russian exports clearly doesn't seem to be deterring the market there. Also, when you look at the Russian exports for the month of Feb, markets are quite positive on that as well. Russia continues to cater to the Asian demand. So even as the international markets are trading at $80 or $85 a barrel, you have the Russian Urals trading at $60 a barrel. And then also there is further discount coming in for the Asian buyers there. So that is what really means that there is availability, affordability, and a big discount that the markets seem to be working with. China's back and with a bang, and we're looking at the equity markets trading on a firmer note. Chinese demand for the month of January has been on the stronger side, and COVID cases from its peak have declined by 70 to 75%. That, of course, is a big positive coming in for the crude oil prices, is the reason you still have prices trading at around $80 to $85 there. The markets will now watch out for the US Fed meeting on 1st of Feb, and you also have the OPEC and allies meeting happening on the 1st of Feb as well. So that is one day that has a lot of events coming in into the markets. And not just crude, take a look at the natural gas prices. We're down by 6% onto this one. Last week was a 20% of a decline. Last 6 weeks, we've seen natural gas prices continue to decline, and within the 6 weeks, 57% of a decline is what we've seen in case of natural gas. When you look at the Europe winter, that continues to be mild. Exports from US have been on the higher side. When you look at the Europe capacity, or rather the inventory holding, that stands as a tall 74% as well. So whichever way that you look, markets are looking at further decline coming in, especially for the natural gas prices also. A quick look at the report card for what we've done for the first month of 2023. And while it has been positive for the WTI and the Brent crude prices, gasoline and heating oil demand also has been on the stronger side. But a big sharp cut is what we are looking at in sense of natural gas prices, and coal as well has seen a decline of 11% for the first month of this year.
All right, Manisha, thanks a lot for getting us that complete roundup on what's really going on with the energy prices. But with that, we're going to get into a short break now. When we return, we will get a corporate conversation going on the back of Q3 earnings. LG Balakrishnan will be joining us to discuss how the quarter really looked and their outlook going forward. Hey guys, welcome back. You're still tuned into Trading Hour. For the markets, we're still seeing a 50-point cut on the index. So it is 17,550. That's what we have on the Nifty. But the main pain is really coming through from the banking names. So the Nifty Bank, after recovering, in early trade from the opening levels, has again completely lost that. We're down 400 points in the Nifty Bank, 1 entire percent gone there, led by several of the larger names. We'll talk more about that. But first up, let's get a corporate conversation going. We have LG Balakrishnan. That is the stock on our radar now after their earnings. So the company saw muted revenue growth this time around. It was absolutely flat. The gross margin has also remained quite constant at around 54%. But, it was the high employee expenses this time around, which has actually impacted the EBITDA margin. So to discuss how the quarter really looked and the outlook going forward, we're joined by B. Vijay Kumar, who's Chairman and Managing Director of the company. Mr. Vijay Kumar, thanks a lot for joining us. This is Pavitra. It has been quite a muted showing this time around, but if you could just break it up and tell us what kind of volume growth you saw in this quarter, in Q3.
Good morning to you. We've grown the last quarter by about 8%. I had said earlier that we will continue to grow at 10%, but due to market conditions, we've grown by about 8%.
So how much, okay, 8% is the volume growth that you've seen versus what you had earlier predicted of around 10%. Can you tell us if what you're seeing in the market in terms of demand is something you expect to continue? And what is the kind of volume growth you can expect for the full year?
We will continue to target 10%. I think we may have to be satisfied with about 9%. We've done 1,600 crores now. I think we will reach 2,150 crores. Maybe about 30 crores less than what we had estimated.
Okay.
But the market continues to be good in India. The American market is becoming very cost competitive. And the growth in the US market may affect our growth also a little bit.
Sir, exports is about 12% of your revenues, right? And that's where you are seeing some pressure, overseas market?
Yes.
Okay. So could you elaborate in terms of when you say that the overseas market is getting price competitive, what exactly is happening over there? Does it necessitate you to bring down prices?
See, a good thermometer is our subsidiary in the US in Detroit. Our company, GFM, has faced some cost pressures. The salary levels have gone up, the input costs have gone up, the turnover has not increased proportionately. So we see some amount of pressure and some inflation in the US.
Okay, that's an important point to note, and thank you for sharing those details with us, Mr. Vijay Kumar. So that could perhaps explain the slight dip we've seen at the EBITDA margin level as well. Now, let me take this question to your CapEx plans, because you had fairly significant CapEx lined up, 200 crores in FY23, 150 crores next year, and I think another 125 odd crores in FY25. Given what you're describing and what you're seeing in the US market, will you be rethinking any of this CapEx? I'm not sure if any of it was being deployed towards that market, but any change in these figures?
No, ma'am, we are not changing anything. We will continue to invest because we have started investing in our industrial chain plant, and we can't stop in between. We will continue to finish the project. Totally, we will spend about 250 crores on that project.
What's the incremental revenue? I mean, what will be the execution period for this CapEx to come on stream? And some ballpark sort of back of the envelope calculations in terms of incremental revenue then?
The plan should be ready. I had indicated June, maybe we will be delayed by about 2 or 3 months. So by September, we should start production. We have already started selling some amount of industrial chain. And over the next 2 years to 3 years, we will definitely reach the equivalent of our investment in terms of turnover from there.
All right, got it. Just one final question, Mr. Vijay Kumar. You know, last time when we spoke, you said the EV contribution is very minuscule. It's quite negligible. Considering that there is so much happening in terms of the new launches for two-wheeler EVs, is there any change to that?
Right now, no. I can maybe tell you about it next year.
So are you planning to increase contribution from this, even if it's next year?
We will get some contribution from that. See, we have signed a lot of NDAs, so I can't disclose too much.
Okay. Sir, unfortunately, run out of time, but thank you very much for joining in. That's LG Balakrishnan guiding for FY23 revenues of 2,150 crores, perhaps about 30 crores short of what they were earlier anticipating. Volume growth could be closer to 9% versus 10% that they were earlier hoping for. And there is some pressure that they're seeing on the cost side in their overseas business, the exports. Get into a short break on that note. On the other side, we'll tell you which stock is on our radar from our list of top 20 stocks to watch out for this year. On to a special now. Like we've been telling you, CNBC-TV18 has compiled a list of top 20 stocks to watch out for this year. It's a carefully curated list of companies that warrant a closer look in 2023. Nigel is now standing by the big wall with a company from the cement space that he has for us. Nigel.
Well, that's right. Today on my radar, Sagar Cements. The stock has corrected close to 20% from its recent fund infusion. It has been scaling towards a 10 million ton capacity, and has also been focusing on its presence in the non-South market as well. Well, its financials have been dwindling, but has shown some bit of an improvement on a sequential basis in the past quarter. The EBITDA per ton has recovered to nearly around 400 rupees per ton, and the good news is now they're selling close to 1.2 million tons per quarter, which equates to close to around 5 million tons per annum. They have been setting up capacities in non-South regions as well, with some presence in Madhya Pradesh as well as in Odisha. Now, from being a South-focused company, they have now started selling some of their production in Madhya Pradesh, Maharashtra, as well as in Odisha. Additionally, the company has been focusing on the cost side by improving the operational infrastructure, by building railway sidings, captive power plants, as well as waste heat recovery systems. Now, all that will benefit them in the coming years on the cost side. The company has hit their targeted 10 million tons capacity ahead of their goal, which was 2025. As a resolution professional of Andhra Cements has declared Sagar Cement as the successful resolution applicant. Now, valuation-wise, the stock trades at a sharp discount to replacement cost of close to under $100 per ton. Now, the enterprise value includes 1,000 crores of debt, of which 500 crores is attributed to Andhra Cement acquisition. So, X of Andhra Cement, well, the debt as well as the capacity, the stock trades at around $51 per ton. And assuming they incur another 500 crores of capex to get Andhra Cement operational, they still trade at around $55 per ton, which is a sharp discount to replacement cost for a rather larger size company, 10 million tons odd. Focusing on the shareholding pattern in the past year, PI Opportunities Fund, which is an affiliate of Premji Invest, they bought close to 10% stake at around 265 rupees a share. Besides that, the promoter entity has close to 45%. You have Belgium-based AVH Resources that has close to 20% stake in the company, while the remainder is split between various large domestic as well as foreign funds. The key triggers to track from here on include scaling towards more than 6 million tons from the current run rate of around 5 million tons, ramping up the newly acquired Andhra Cement, as well as the debt. Can it peak out at around 1,500 crores odd?
All right, Nigel, thanks a lot for getting us all of those details on Sagar Cement. As a quick standard disclaimer, this is not a stock recommendation. The CNBC-TV18 editorial team does not advise on trading or investing the stock market. Any investor or viewer is advised to carry out necessary diligence on their own or through a certified registered financial advisor for investment decisions.
Welcome back. Well, the market continues to struggle around, but we're not really caving in, and that's the good story. So it's been very steady since the time the three of us actually came into the studios. Still a cut of around 40 points. Nilesh Shetty, portfolio manager at Quantum Advisors, is with us now to discuss market fundamentals. Nilesh, good afternoon, good morning, almost afternoon to you. So it's been, quite a double whammy of sorts, budget, and then, of course, all the noise around the Adani group of stocks. What have you made of it, first of all? And when do you see the market perhaps moving beyond some of these big noisy events?
Yeah, I mean, we've always had a corporate governance filter in our investment basket. I think some of the investors who are trying to invest over long term in India sometimes forget the long term risk of allocating without focusing on corporate governance. So in that sense, at least our portfolio has always been built assuming corporate governance is the first filter that companies have to sort of pass through. And some of these large groups in India, which in fact are very large parts of the index, have never been part of our portfolio. So I think just near term, sometimes we have to bear the brunt of underperformance because of that. But over the long term, we've always seen those risks come out in the open. So again, it's something which has not bothered us that much. A lot of the information that is out there has been in the public domain. So we've always built a portfolio X of companies where we felt corporate governance was an issue. Again, on the environment, again, we don't think on the ground things are not that bad. I mean, there's a lot of negative news flow in India right now because of news flow that's coming out on certain groups. But when you go on the ground, things are very positive. It's actually been, most of the companies are very positive on demand and you're not seeing any kind of slowdown. There might be some impact of large bases as last year numbers are stronger and this year you have to report on those strong numbers. But apart from that, the environment is very, very different to what it was, say, 3 years ago. And most of the companies are looking at very strong demand and looking at expansion to meet that strong demand. So I think we think a capex upcycle is due. We think the budget, given that it's a large budget before you head into national election next year, which is the last full budget, it is unlikely to be not an expansionist budget. We expect the government to spend quite aggressively in this budget. And given those catalysts, it is unlikely to, at least for us, for the earnings to not show traction over this year and next year. So again, we remain fairly constructive on Indian markets. We think there is fairly decent upside in select sectors. And if you're selective in how you build your portfolio, you will make decent returns over the next 2-3 years.
All right. Nilesh, good morning and thanks for joining us. But, at a time when we do have at least the budget lined up, how would you approach it right now? Do you look at some of the standard, themes that we tend to discuss before the budget, the infra plays, the construction companies? Do you think those are good bets to look at?
Yeah, I mean, we are not tactical allocators because our investment horizons are very long. We don't try and play the budget. But yes, there are large pockets of opportunity in the market where valuations have come off. And some of these were actually growth sectors, say, 2 years ago. So we are actually find opportunities in the consumer discretionary space, especially two-wheelers. We have a large allocation there. We have allocation to a lot of the savings-linked themes now, say the asset management companies, the broking companies, the insurance companies, which were priced to perfection, say, 2 years ago, but have seen significant de-rating over the last 2 years. Again, our numbers are not materially different from the street, just that we were willing to pay a lower multiple, which these companies are now trading at. So I think there is opportunity there if you want to build up a portfolio for the next 3-4 years. I think some of these names are trading at very attractive valuations with decent growth traction over the next 3-4 years.
Nilesh, any thoughts on Bajaj Finance? This is a company which was seeing high growth a couple of years back. The stock has seen a fair amount of correction from peak levels. It's down 25% from its 52-week high levels. The company does intend to focus on other avenues, other products like car loans, CV loans, microfinance, agri loans to start, getting back to its long-term growth aspiration of 24-25%. Is this a stock that you would bet on? And your thoughts on their plans?
Yeah, I may not be able to comment on individual stocks, but again, it's a value portfolio, focus on value side. Some of these NBFCs which trade at very high multiples, again, assuming very high growth rates to be sustaining over the next 5, 10, 15 years and priced for that. Again, that is not the style that we approach. I think people generally tend to get disappointed because these stocks tend to mean revert to industry averages far more quickly than what people think. And paying very high aggressive multiples for such kind of businesses has not worked out historically. So again, if it comes at a valuation that we are comfortable with, a great business to own. I think it's a fantastic story that they've built. But for us, again, that these kind of businesses trade at such high multiples that in a value portfolio never made sense.
Nilesh, finally, then, how do you describe value, or what do you call value in a market like this? And I'm just wondering if IT at all fits the bill. It was the underperformer of 2022, and world over, there's a big move into IT, back into technology. What's your call?
That's correct. So at the first half of last year, we trimmed a lot of IT stocks that we had because valuations were sort of factoring this case scenario. After the correction that happened in the second half of last year and even sort of late in last year, we started increasing our weight in IT. Again, long-term growth rates are not materially different. It's just that what is the kind of valuation you want to pay for these businesses? We think there is still long headway for growth at a normalized growth level, not the high growth that we saw from 2020 to 22. But even if you factor a lower growth rate, the multiples that they were trading at, say, in the last quarter of last year, was fairly attractive. For us, sort of the downside risk was a lot limited from that point on. And we think if the numbers come through, they will give you fairly decent upside. So yes, we have increased weight in IT.
Have increased weight in IT. Nilesh, it was a pleasure speaking to you, and we'll hope to connect soon once again. Thanks for taking out the time and speaking to us today. But with that, we're going to get into a short break. You don't go anywhere. There's lots more market action coming up for you in just a bit.